Welcome Nellore Tirupati Ongole branch members and today's speaker Deepak Narang sir to this webinar on personal wealth building and smart investment opportunities for chartered accountants. I am delighted to see you all gathered here today. As CAs, we are all well versed in the art of managing finances for our clients. However, it is equally important for all of us to focus on our own financial wealth being, well-being and secure our future. In today's fast-paced and ever-changing economic landscape, it is crucial for us to stay informed about latest trends and opportunities in the world of investments and wealth management. I personally thank today's speaker, CA Deepak Narang sir, for taking his time out of his busy schedule for today's webinar. I hope everyone find today's webinar informative, engaging, and valuable. Let's make the most of this opportunity to learn and grow together. Thank you.
Thank you, Rajesh. I request CA Ravindra Reddy sir, Chairman of Tirupati branch, SRSFICI, to his opening remarks. Sir, over to you.
Sir, you are on mute.
Sir, you are on mute.
Good evening, everyone. I think I am audible now.
Yes, sir. Yes, sir. Yes, sir.
So, good evening, everyone. It's my distinct pleasure to welcome you all to this highly anticipated webinar on investment opportunities. We all know how important to manage our finances wisely. Whether you are just beginning your financial journey or looking to grow your wealth further, today's session is for you. The insights shared today will undoubtedly equip you all with the knowledge and strategies needed to navigate the complexities of the financial landscape. We are privileged to have us today Sri C.A. Deepak Narang, a distinct chartered accountant from New Delhi, whose expertise in financial planning and investment strategies is well recognized. Mr. Narang's deep understanding of market trends and his practical approach to wealth building make him the perfect speaker for today's session. So we are eager to hear his perspectives on creating sustainable financial growth and smart investment opportunities. I would like to extend my heartfelt thanks to the Nellore and Ongole branches for their collaboration in organizing this event. Such partnerships enhances our ability to deliver high quality content and foster a strong professional community. I am confident that you all will find this webinar both informative and inspiring. So thank you. Thank you, sir.
Thank you, sir. Thank you for the valuable information, sir. Sir, this is a small brief introduction about our today's speaker, Senior Deepak Narang, sir. Sir, just a few minutes, sir. I will introduce our speaker and then you start the session, sir. Student competent finance professional with, sorry, sir. CA Deepak Narang is a proprietor of Deepak Narang and Company. His background was an astute and competent financial professional with over a decade of rich experience in the finance and accounts, internal control, audit, taxation, and financial advisory services. As the proprietor of Deepak Narang Company since January 2018, he has gained executive expertise in income tax, GST work, alongside providing comprehensive financial advisory services, including portfolio and wealth management. His a prior role at Ford India, Samsung Electric, have honored his skills and financial planning, internal audit, and strategic financial management. Area of experience: financial planning and control, fleet business control, finance and accounts, pricing and revenue functions, wealth management, internal audit, income tax and the GST, portfolio management. And the Mr. Narang professional experience, currently having income tax and GST related work, works of individuals and firms and providing financial advisory services, wealth advisory, and portfolio management to the individuals. Experience in contributing towards improved financial performance, monetary monetary savings, revenue enhancement, heightened productivity, and efficiency gains. Worked with almost 200 clients and helped them in managing their finance and marketing their portfolio and generating wealth from them. This is the brief introduction about C. Narayan, sir. Please take over the session, sir.
Hello, everyone. I'm really excited to take this session with the Nellore branch. All the participants. Thank you very much, Mr. Reddy. Thank you, Mr. Yuvraj, and I would like to give a special thank to Mr. Shravan, who I think referred me for this session. My journey start. I'll just give a small brief about me. My journey started with after becoming a CA in 2009. I joined PKF Sridharan Santanam as I was the first employee for them in Delhi. So I learned a lot. I have a very good relation with, I mean, I would say my career started with South Firm. So I have like very good bonding with them. So I was always looking for the opportunity that in the southern part, I'm sitting in Gurgaon. In the southern part, I somehow joined back then. I mean, I had very long relationship. In Ford also, I was there in Chennai for 2 years. So I wanted to start join back. When Shravan told me, I really felt excited and to take this session. So now I'll take you to this session. I'll present also in few seconds, but just to brief about it, we chartered accountant mainly provide services which clients look for, but mostly we manage their financials. We manage our company's financials. We manage we audit them, we check them, we create a goal for them, we help them to making goals, but somehow we forget that we have to create goals for ourselves also. I have met so many people. I have met so many chartered accountant also. I myself I talk about. I could never able to make my personal finances. I was busy with my work here and there. I was not clear that where I should invest. What is the annual return I'm getting out of it? How the I can create my wealth? What should be my financial goals for future? So those things where I think even we have been called as financial experts, we knew from inside. I myself, I can say that I knew from myself when I was part of Ford Motor Company. I was doing job, so I can say that I was not managing my financial well. I was putting some money here there, but no consolidation, no goals, where I want to reach, what should be my retirement goals, what should be my if I want to buy a house, what should be my goal. I did not prepare for that. So then somehow I got my advisor and he opened my eyes. As a CA, we have our self ego, which I had. And I said, I know everything. But one day it actually opened my eyes and I took his help. And then I came to know how the planning happened, how you can manage our individual finances. It's a very simple thing, but most of us, are not doing it. So I'm taking you through the wealth creation journey. It's a simple process, but it's nothing complicated. But it is a long process and very disciplined process, so people don't follow it. I'm sharing one presentation. Through that, I will take you through. First, yeah, we will talk about. Just a minute. You are able to see my screen?
Yes, sir.
Okay. So first we'll talk about. First, I would like to say that I have never got opportunity to present wealth creation journey in front of chartered accountants. I'm in Gurgaon branch. I could never able to do that. But outside CA world, I got a lot of I did a lot of presentation. I took through various seminars and various places. So if I, as a brother, if I make any mistake or anything, please forgive me or correct me, or I would like to improvise myself. Fine. So I will talk about wealth creation journey here. So to create a wealth, we need to be very consistent first. So first thing which stop us in
Some of the
stating
members
our
are messaging that your voice is somewhat low, so
my
that
voice is low.
please
Okay.
adjust your mic.
Okay. I think I had my best
Okay.
headphone with me, but I don't know why voice is not clear.
So
Is it
the
audible
people
now?
are messaging. Yeah. Okay.
Is it audible to you, everyone?
Yeah.
Yeah, yeah, audible, audible.
Okay.
Yes, sir.
So I would
Audible, sir. Audible.
so stay with me for 1.5 hours to 2 hours because this session will be there. If I am going slow, please, Yuvraj, please tell me, and then I will speed in
Yes.
myself accordingly.
Yeah.
We will talk about why investment is important. We will compare various kind of investment options, traditional, advanced, all kind of options, and then see how in last few years it happened. Then we'll talk about equity. Then we'll talk about mutual fund. Then SIP. Then how we plan the investment, and then SWP, and then we'll compare mutual fund versus property investment. So why so many people and government is giving so much of aid of mutual fund? We'll talk about why that is very important for a common man like us, for everyone. So I have one question from every one of you. Is why investment is important? Anybody can answer? Because I want to make it interactive. So if anybody can, yeah,
To be secure.
to be secure. Okay. Anyone else? We are the finance guys. We have to give answer from our finance angle.
Meet the
Just think.
Investment
uncertainties and
is
to beat inflation.
so
Yes, that's
investment. Sir,
yeah.
good evening. Investment is nothing but the way how definitely whatever be the earnings that we expect earnings from earnings. That's
Yes,
what the way
yes,
we'll
that's
think about investment.
yeah, you are talking about compounding. Yes, that's what is also. So the main reason, which Mr. Yuvraj has very well correctly said, is inflation. If we will not have invested our money somewhere, the saving after our expenses invested, it will eat our money. If we keep somewhere in our house cash, and the value of money will decrease. If we keep in saving bank account, the value of money will decrease. How it will impact us? It's because of inflation. So I think this screen I'm sharing on the top of it, you are able to see the full screen, or I mean,
Yeah,
or
full
is
screen is visible, sir.
okay, fine. So the biggest hurdle is inflation. So if I talk about everybody consume petrol in their car, they put petrol, diesel in their car, everybody buy gold, everybody take milk. So if you see a last 30-year data, the inflation has hit with 6.5% in last 30 years to us. How it impact us? It impact us like 990 the price of gold was 3200, which is in 2023 59,000. Price of milk was 6 rupees, which is now 72 rupees. So inflation, if we count it on an annual basis, the inflation rate is 7.82% for milk, for diesel 9.98%. And it eat up our money. It gradually, if we won't invest anywhere where our return is more than the inflation, it will eat our money. How it eat up? If in 1990, if we had 1 lakh rupees, the value of that money today is 12,500 rupees. So we have to invest somewhere. That is very clear. If we keep the money with us, our saving with us, the value of that money will go down, and we won't be able to buy those things which we plan to buy from that. Or we plan to, for example, we want to save for a retirement. We want to save for our children education, their marriage. So we won't be able to have enough money if we don't invest it somewhere. So that is very important. We like in 2005, if the household expenses were 15,000, today they are 50 to 60,000 rupees. So gradually 6.5% is hitting us every year. It's a slow that it is giving. So we have to invest somewhere to earn a better return. Higher education, I know that when I passed my CA, nearby that at the time MBA cost was somewhere, if you had to do IIM Ahmedabad MBA, the cost was 3.5 to 4 lakh rupees overall. Now it is 20 to 25 lakh rupees. Easily you have to spend, even you get selected, you have to. How the cost of education is increasing because of inflation. Gradually it is hitting us. Everybody is hitting us. So we have to invest somewhere, otherwise it will impact us. Guys, you understand Hindi or I should skip this video? It's in Hindi.
Many can understand, sir. You play the video.
Okay, I'm playing the video which is talking about the basic of investing.
फर्क सेविंग और इन्वेस्टिंग में। तो आप एक बहुत ही मेहनतकश इंसान हैं, अच्छा खासा कमाते हैं, अपने लाइफस्टाइल से बेहद खुश हैं, और हां, अपनी कमाई में से 20% हर महीने बचा भी लेते हैं। सेविंग्स बहुत अच्छे। अब चलते हैं आपके रिटायरमेंट की तरफ। देखें तो अब तक आपने कितनी सेविंग की है? अरे ये तो आपकी उम्मीद से बहुत ही कम है और आपके कलीग के मुकाबले तो कुछ भी नहीं है। पर आखिर गड़बड़ हुई कहां? दोनों ने एक सा काम किया, एक सा कमाया, एक सा बचाया, तो फिर दोनों के रिटायरमेंट फंड्स में इतना फर्क क्यों है? फर्क इसलिए है क्योंकि आपने पैसा बचाया जबकि आपके कलीग ने उसे इन्वेस्ट किया।
तो सेविंग्स क्या है? एक आदमी की मंथली इनकम में से उसके खर्चे निकाल दीजिए। ये खर्चे कुछ भी हो सकते हैं, खाना पीना, मूवी देखना, मॉल में जाना, बच्चों की स्कूल फीस, या घर या कार के EMIs, या कुछ और। इन खर्चों के बाद जो पैसा बचेगा वो होगा सरप्लस। तो फिर इन्वेस्टिंग क्या है? सारे खर्चों के बाद जो रकम बचती है वो कहलाती है सेविंग्स, जबकि इन्वेस्टिंग इसी रकम को बढ़ाने की क्रिया है। कंफ्यूज्ड?
इसे हम इस तरह समझ सकते हैं, आपके पास आम की 100 गुठलियां हैं, यह है आपकी सेविंग्स। अब या तो आप इन्हें इस बक्से में जमा करके खुश रहिए, जो काफी बेवकूफी भरा काम होगा, या फिर आप थोड़ी सी होशियारी दिखाते हुए इन्हें जमीन में गाड़ सकते हैं। अगर आप जरा सी प्लानिंग करें और थोड़े से सब्र से काम लें, तो आपको मिलेगा असली फलों से भरपूर आम के पेड़ों का एक झुंड। इसलिए गुठली को बेकार न छोड़ें, उसे जमीन में उगाकर तब तक देखभाल करें जब तक वो पेड़ नहीं बन जाती।
ये सारी क्रिया इन्वेस्टिंग की क्रिया की तरह ही है। इसको इस तरह से देखिए, सेविंग्स कच्चा माल है और इन्वेस्टिंग वो क्रिया जिससे उसका फायदा उठाया जा सकता है। तो शुरुआत सेविंग से करें और फिर उसे सही इन्वेस्टमेंट ऑप्शंस में इन्वेस्ट करके नेक्स्ट लेवल तक पहुंच जाएं। पर ये नेक्स्ट लेवल है क्या और सेविंग्स को वहां तक ले जाने की क्या जरूरत है?
मान लीजिए आप अपनी बेटी को 10 साल बाद डॉक्टर बनाना चाहते हैं और उसकी पढ़ाई का कुल खर्चा आज के हिसाब से करीब 50 लाख रुपए का होता है। मतलब अगर आप हर साल 5 लाख रुपए बचाएं तो 10 साल बाद आपके पास पूरे 50 लाख रुपए जमा हो जाएंगे। सही बात है ना?
पर क्या 10 साल बाद भी उसके लिए इतना पैसा काफी होगा? नहीं। तो इसके लिए जिम्मेदार कौन है? इन्फ्लेशन। 10 साल बाद 6% के एवरेज इन्फ्लेशन रेट से उसी पढ़ाई का खर्चा 89 लाख से भी ज्यादा हो चुका होगा।
अब या तो आप अचानक हर साल करीब 9 लाख रुपए की बचत करना शुरू कर दें, या फिर अपनी लिमिटेड सेविंग्स को जरा होशियारी और नियमित रूप से हर साल कुछ इस तरह इन्वेस्ट करें ताकि 10 साल बाद आपको आपकी मनचाही रकम मिल सके। जी हाँ, इन्वेस्टमेंट आपकी सेविंग्स को सही दिशा में ले जाकर आपकी हर जरूरत पूरी कर सकता है, ताकि सालों बाद आप अपनी बेटी की मेडिकल एजुकेशन के लिए जरूरी पैसा इकट्ठा कर सकें।
सेविंग्स को इन्वेस्टमेंट में बदलने के लिए जिस चीज की बेहद जरूरत पड़ेगी वो है डिसिप्लिन। मामला सिर्फ डेडिकेशन का है, एक लंबी अवधि तक नियमित और सुचारू रूप से सेविंग और इन्वेस्टिंग करना। पैसा खर्च करते समय काफी समझदारी बरतें। अपनी रकम को लक्ष्य ध्यान में रखते हुए इन्वेस्ट करें और लक्ष्य को पाने की समय सीमा निश्चित कर लें। सेविंग्स और इन्वेस्टमेंट एक ही सिक्के के दो पहलू हैं। सेविंग से फ्यूचर गोल्स को प्लान किया जा सकता है, तो समझदारी से इन्वेस्ट करके उन गोल्स को पाया जा सकता है। क्योंकि ऐसी डिसिप्लिन भरी सेविंग का फायदा ही क्या जिसे समझदारी के साथ इन्वेस्ट ही न किया जाए।
चलिए इस सब पर आखिरी नजर डाल लेते हैं। अपने खर्चों पर काबू रखकर आप बचत कर सकते हैं। नियमित बचत करें, लंबे समय तक करें और उसे सही तरीके से समझदारी के साथ इन्वेस्ट करें। चलिए एक बार फिर आपके रिटायरमेंट की तरफ चलते हैं। वाह, आप तो 65 साल की उम्र में भी ऐश कर रहे हैं। बड़ी आसान सी बात है, बचत करें और इन्वेस्ट करें। आशा है आपको वीडियो पसंद आया।
So, I hope it gives the clarity that why investment is important. Fine. If anybody has a question, you can ask because I want to make it interactive so that we keep talking on things. I'm talking about basics here. The basic is
होगा
why investment is important. Now the second topic is, yeah, investment is important, but where we need to invest, that is very important. So I have compared all traditional investment with the equity, just equity, straight equity. I'm not talking about mutual fund here. I'm talking about only equity. So in last, this is the data from 1982 till 2023. If somebody invested 1,000 rupees in 1982, with inflation, it would have become 12,710. I mean, if his return inflation was 6.4%, if his return is up to 6.4%, his value of 1,000 rupees would be 12,710. On the other side, I know the gold has is booming from last few months, but if I take a data of last 40 years, the return is 8.463%. It means your 1,000 rupees has become 29,740 rupees as on today. On the other side, if you would have invested in silver, where 8% return, real return is 1.5%, your 1,000 would have become 23,280 rupees. And now let's take example FD. If I talk about 10, 15 years back, the FD was very interesting area to invest because at that time return was somewhere 8 to 9%. Even it touched 10% also sometime a very old time, I mean 10, 15 years back, 15, 20 years back. But right now the returns are between 7, 7.5%. But I'm taking the last 30 years. So it says that 8.3% return has given by FD. So your 1,000 rupees has become 26,280 rupees. Today it is not possible, but still I'm taking the data of last 40 years. Now I'm taking about company deposit means PPF, company PF, all those things, or the government related schemes which are there. So maximum return was there 9.3%, which is still lower currently. You can't earn more than 8% there. But I'm taking the average of 40 years. That 1,000 rupees would have become 38,310. Now I'm talking about Sensex. It's just Sensex. When the Sensex started, it was 100 points. Today it is around 75,000 points. Sensex. If I take an annual return of 14 to 15%, which it has created, the value of 1,000 rupees is today is 2,70,970 rupees. So it very clearly say that there is no comparison between equity and any other investment, any other traditional investment. I have not taken property into account because there is no standardized property data. So we will handle it separately in the last slides. I have prepared separate data for that. I cannot take any standardized data for property. So all the standard investment options which I told you guys, traditional or where people are investing, equity is a clear winner, and there is no comparison at all if you are long-term investor in equity. Your 1,000 rupees has become 2,70,000. On the other side, if you compare any of the best return, maximum it has become 38,000. So over a period of time, you create good amount of wealth through equity. But why people are not able to invest, we'll talk about that. Now I'm talking about FD. FD is, everybody say that fixed deposit is the best place to invest when there is a safety. But when we are going for extra safety, we are actually taking higher risk because you are currently, a period came when the return from the FD was 5.5 to 6%. And in future, it also look like rate of interest will go down for longer time. If I say 5 year or 10 year down the line, the rate of interest will go down because we are moving toward developed economy. So definitely rate of interest will be down. So in last 10 years, the rate of interest has 20 years rate of interest has gone down from 9% to 6.5%. So it is continuously going down. Even now, FD after tax is not able to cover your inflation as well. So not taking risk has become more riskier. So while investing in equity in FD for longer term, always think that it's not able to cover FD itself. Sorry, inflation itself. On the other side, if I talk about Sensex return in 1979, it was 1,000 rupees. In 23, it was 58,000. Currently 75,000. But I am taking this data till 31st March. In 43 years, it has given an annual CAGR return of 15.6%. And it is very, very impressive according to me for longer term. If anybody has invested for that much of period, he will create huge amount of wealth. But why people don't invest in equity? why people fear that not everybody don't invest in equity because of this sheet. If I talk about this journey, this says that there are lots of ups and downs. Now I'm talking about 2002. In 2000, 2001 and 2, there was no return in the market. So 3 year people waited. So many people went away because they said there is no money. And then 1 year, in 1 year, which was 2003, only 1 year return was 72%. And then it was consistent 13%, 42%, 47%. So this 4 5 years, Harshad Metal time, this was very, very good. No, after that time, there is this time was very golden period for equity, but then the dot-com bubble in 2008 happened. Not dot-com, I think subprime crisis happened in 2008. Anybody invested at this period because this was a booming period, so everybody was investing. Anybody who invested in this period, for example, 1 lakh rupees, is 1 lakh rupees became 48,000, but that was not an actual loss. This was an unrealized loss. But people got fear out of it. They went away. They start going out of the market. They sold it. They said this is not a good market. Then within a 1 year, it gives a return of 81% within a year. And then ups and downs keep on happening. In 2020, again, the COVID happened. Your wealth went down by 40%. But now from that period, it is continuously going up. So the journey is not in a sequence like FD. It is not in the give the every year 6, 7, or 8%. It will have some time minus return. It will have some time higher return. But if you trust in India growth story, and if you are a long-term investor, you need not to worry. If you stay there for 5 years, there is no chance of negative returns, and I will prove with the data as well. So the journey is ups. There are a lot of ups and downs. That's why people don't invest. Not everybody invests. They have a fear of losing the money. But if you plan it well, you can manage it well. So what drives the equity market? We all are financial professionals. We know that in short term, there are so many things. News comes, these traders keep doing buying and selling, then the liquidity happen, sentiments come in the market. Like recently happened when the government was under a threat of not making a full government. In one day, we lost 4,000, the Sensex lost 4,500 points. This was because of some fluctuation on short term. So people get fear from that. And that's why they stay away from the market. They said, this is not the right place for me. I cannot create money out of it. But if you talk about longer run, only the profitability of company drive the market. If any country has good GDP, means their companies are making profit, the companies have a good future perspectives, country has a good future perspective, which India has. Continuously, we are having one of the best place for the GDP growth rate. We had 7.5% future perspective growth rate of GDP. So if we are into that, we need not to worry because we are at the right place. We will make the money because if the GDP will grow, if the country's companies will make profit, your money will grow without any doubt. It has to grow. And I don't think so that next 10 to 15 years we need to worry about it because a lot of development has to happen in India. And in last 10 years, 15 years, a lot of growth already happened, but we are at highest pace of ourselves. And if anybody invests there in equities, then they will make money, but it has to be done in a smart manner. We will talk about that. In last 20 years, market has gone up by 8 times. But how much money you have grown in last 20 years, you have to see. Market has given 8 times returns. Then next question comes in the equity that now the Sensex is at 75,000 rupees. I should not invest. It is at already grown a lot. Nifty is at 25,000 rupees. I should not invest. It is already at peak of itself. So that is a regular question I get. But this is a mistake we do because if I take a data from April 1988 to March 2023, anybody who invested lump sum money, fixed investment, when the Sensex was at highest of its point in 1988 or out of any of these years, and they waited for 35 years, they still made 20% or 12% return, almost 12% return, annual return. On the other side, if anybody at specific time when the Sensex was at lowest point, I'm talking about COVID time, means in 2020, if they invested at that time, he made average CAGR of 13 to 14%. So this is the minimum return I'm talking about, minimum return they made. Anybody has done a SIP, systematic investment plan, on every month on specific date, money get deducted from his account and invested, he still made 12.8%. So what this slide drive is, at particular point of time, whatever the state is, your money will grow if you give time to it. The difference because of this thing is 1 to 2% only. That in longer run means, if you are that unlucky that you purchase the equity, you did the investment when the Sensex at its peak for that year, and you waited for almost 5-10 years, still you will make good amount of wealth. You will lose 1 or 2%. What people does, they keep money in their FD, their RD, their saving bank account, they're somewhere there, and they think that when the right time will come, then I will invest. That right time never comes. They are not able to invest. They are not able to give time to their investment. That's why they are not able to create wealth. So whenever you have money to invest, you should invest at the same time. And how you should invest, we'll talk about. So this is one of my favorite slide, which talk very clearly that how India is rapidly growing now. So it took almost 60 years for India to reach to US trillion dollar. So almost 60 years. But you know how many years we took to reach to $2 trillion? Only 7 years. And how much we took to reach to $3 trillion? 5.5 years. And I'm sure that within 3 years, 3.5 years, we'll reach to $4 trillion, very close to it, we'll reach it. So we are growing at the fastest we could since independence. This is the maximum growth time for India. So if this growth time you want to participate as a part of this growth, you need to be part of equity. You have to invest in equity. That is very important. This is the best place to create, if you want to create wealth for yourself. Then you cannot avoid equity if you want to create wealth. So this growth story clearly say that this is the peakest time for India, GDP growth. You have to be participant to that. So any question till now? I have spoken a lot. So anybody has any point, anything you want to ask, or anything you have anything on any slide, or should I move further? Okay, I'll move further. No questions. Okay. So we are not investing in Sensex. We are investing in mutual fund. Why we are investing in Sensex? Why we are not investing in equity? Because our job is my job, I'm saying, I'm into finance. I'm saying a regular, when I was doing a job in company, when I was handling some other work, I was into either financial of a company. I was either into to the work given by my boss. I was doing that, or I was busy at home. So I was not fully dedicated for equity. So if you are not having full time for equity, equity become very dangerous for a regular client. If you are expert in it, no problem at all. But if you are not expert in it, it becomes dangerous, it's backfire, and then you are not able to manage your emotions. When you manage your own money, and you invest in equity, there are a lot of fluctuation. Equity means you bought few shares. For example, I have 1 lakh rupees. I invest in equity, and I want to buy for example, some share of MRF. I will get not even more than 1 share. That's what I'm saying. But if I have been to buy to mutual fund of some specific fund, I'm able to diversify money. My money is going here, there, and various equity, various share, and they are being managed by professionals. Here, I'm managing my money, my emotions, my greed, those things are attached with the investment. And when those attach it, I will show the data. You are not able to create wealth. This is a global data, because when Mr. Bill Ford will start managing the financial of Ford Motor Company, the company will not be able to grow. That's why they hired a CEO of the company, Mr. Jim Farley. That's why they hired a big management company, they're financial experts who are managing it, because they don't have any emotion attached with the company. They are earning salary, they are doing their job. That's the same way apply for your personal finance also. When you have to manage your money, you are with your emotion, you make more mistake compared to the expert who is managing your money, but he is managing money of various people like you, and he's taking all the decision based on the facts, based on the data or analysis he does, rather than doing based on the emotions or guts. So why mutual fund came into existence? When you plan, you think that goal is in front. I will invest for 20 years. This is the way journey would be like this. But the journey is not like this. Journey is like this. You have lots down, lot of up, lot of down. And in those downtime, how you manage your emotions, how you manage your difficult time with yourself, that really matters. And most of the people are not, the data says that most of the people are not able to manage the emotion at the lower time when the market is going down, people are losing money. At the time, managing emotion is very difficult. So this is a US data. This is a source from US, because in India this kind of study doesn't much happen. So I have taken the input from them. Till 1989, from 2008, average stock fund return, minimum return was 8.4%. But average stock fund investor, people who invested themselves without the help of advisors or a mutual fund expert, or I will say with the experts, they made only 1.9%. This is the difference. So equity market will give return, but you won't be able to make it because you won't be able to manage emotions. This is one more point. 1984 to 2014, 11.06% was the return of S&P index, but average equity fund investor return was 3.8%. The reason they are not able to make money because of their behavioral gap. So we have to manage that gap. That is very important. So that's why the existence of mutual fund came. The expert will manage your money. They will actually balance it out. When we are making a lot of money, I'm giving one disclaimer. If you are an equity expert, then nothing is better than equity. But if you are not an equity expert and you are doing in bits and pieces, then it becomes dangerous for you. So I'm just replaying one more video. I know most of you will have basic information about mutual fund, but it's my duty to give the information if somebody is not aware about it.
ये म्यूचुअल फंड क्या होते हैं? म्यूचुअल शब्द का मतलब है लोगों का एक साथ आना और फंड्स का मतलब है पैसे साथ में जमा करना। इसलिए म्यूचुअल फंड्स का मतलब है कुछ लोगों का अपने पैसे साथ में जमा करना, स्टॉक्स या बॉन्ड्स खरीदने के लिए, और कभी-कभी दोनों एक साथ। या फिर इसे ऐसे सोचिए, एक बेकर हजारों केजी का केक बनाता है। ये केक अलग-अलग अंशों से बना है। ये हर अंश एक अलग स्टॉक या बॉन्ड है और ये सारे अंश साथ में मिलकर आपका पोर्टफोलियो बनाते हैं। ये फंड एक प्रोफेशनल फंड मैनेजर संभालता है जो इन जमा किए हुए पैसों से एक ऐसा पोर्टफोलियो बनाता है जो स्कीम के निवेश उद्देश्य से मेल खाता हो। इस पोर्टफोलियो में निवेश कई अलग अलग सेक्टर्स या इंडस्ट्रीज में किया जाता है। इससे रिस्क पर काबू रहता है। क्योंकि सभी स्टॉक्स एक ही समय पर एक ही दिशा में और उतनी ही मात्रा में नहीं चलेंगे, तो ये संतुलन रखने में मदद करता है। म्यूचुअल फंड यूनिट्स क्या होते हैं और इनका एनएवी कैसे गिना जाता है? म्यूचुअल फंड्स निवेशकों को निवेश किए गए पैसों के मूल्य के हिसाब से यूनिट्स इश्यू करते हैं। म्यूचुअल फंड में निवेश करने वालों को यूनिट होल्डर्स कहते हैं। जब एक निवेशक किसी स्कीम में अपने पैसे निवेश करता है, उसे यूनिट्स दिए जाते हैं। हर यूनिट के मूल्य को एनएवी कहते हैं। ये एनएवी उस फंड के होल्डिंग्स में एक यूनिट के मार्केट वैल्यू पर निर्भर करता है। जब निवेशक उस फंड में निवेश करते हैं तो वो उस फंड के यूनिट्स को उसके एनएवी प्राइस पर खरीदते हैं। चलिए अब फिर से बेकर और उसके केक की तरफ चलते हैं। इस केक को किफायती बनाने के लिए बेकर उसे कई टुकड़ों में काटता है और हर पीस अलग से बेचता है। हर पीस का एक दाम होता है। आप जितनी रकम देंगे, केक का कुछ हिस्सा उसके हिसाब से आपका हो जाएगा। एक निवेशक कितने यूनिट्स खरीद सकता है, ये दो चीजों पर निर्भर है: हर यूनिट का एनएवी और निवेश की कुल रकम। इसलिए स्कीम में हर यूनिट का एनएवी सिक्योरिटीज के मार्केट वैल्यू से स्कीम के कुल मिला के सारे नियमित खर्चे काटकर फिर उसे उस दिन के यूनिट्स की कुल संख्या से विभाजित करके मिलता है। तो अगर एनएवी 15 रुपए है और निवेशक ने स्कीम में 15,000 रुपए निवेश किए हैं, तो उसे 1000 यूनिट्स दिए जाएंगे। तो नेट एसेट वैल्यू स्कीम के एक यूनिट का करंट मार्केट वैल्यू होता है। उदाहरण के लिए केक का एक टुकड़ा ले लीजिए। हर टुकड़े में सारे इंग्रेडिएंट्स अलग अलग मात्रा में है। हर इंग्रेडिएंट का एक मार्केट वैल्यू है। केक में डाले सारे इंग्रेडिएंट्स के मार्केट वैल्यू को जोड़कर केक का एनएवी गिना जाएगा। पर एक चीज ध्यान में रखनी चाहिए कि यह वैल्यू हर रोज बदलती रहती है। क्योंकि सिक्योरिटीज का मार्केट वैल्यू रोज बदलता है, स्कीम का एनएवी भी हर रोज बदलता है।
So this was about the basic of mutual fund, how it works, and I will just summarize it. Investor pool their money, they give it to fund manager. Fund manager can be a very renowned company like HDFC Mutual Fund or Reliance Mutual, Nippon Mutual Funds or SBI Mutual Fund. Any company can be. There are 45 companies registered there. They give it to fund manager. They invest in security based on their expertise. They generate the return. They have their some expense ratio, which is defined by the SEBI. They deduct that, and all the money they give back to investing. So this is the way it is. It works. So how it is different from the direct investing is professional investment management. It is managed by professional. They have very high salaries, and their 9 to 5 duty is just to manage your money. If you're investing into fund, they identify the good stock, they do their research, their own work, and based on that they take decision in buying and selling. So they can do better than job than us. Second thing is risk reduction through diversification. You diversify the money. If you have, like I told you, if I have 1 lakh rupees, it is very difficult for me to diversify my money. But if I put into mutual fund, which is investing already in 30 stocks, 35 stocks, 50 stocks, depend on the objective of the mutual fund, your money will automatically diversify. Some money will be in infrastructure, some money will be in finance sector, some money will be in IT sector. So your money will be diversified. On the other side, in the mutual fund, you have convenience. Convenience means you can increase the SIP as per your goals. You can reduce it. You can do lump sum investment. You can do you can reduce. You can withdraw anytime. Those kind of convenience is available. Like in equity, the level is not that. You cannot make in the same discipline manner the kind of convenience you have in mutual fund. And then you have various objectives available in mutual funds. Means, for example, I want to plan my retirement, my objective will be different. If a person who is already retired and he want to generate a monthly income out of it, of his wealth, his objective will be different. So for every person who is different objective or different portfolio is there based on the objective. So accordingly the investment will be done, which are already developed. And then the unit holder administration and services, where I help my client. I'm
వచ్చే
associated.
నెలలో వస్తాలే నాన్న ఇంకా వచ్చే
Okay.
నెలలో వస్తా.
Please, all of you mute yourself. Someone is on.
Okay, no problem. So we can. This is the main thing with mutual fund is like you can plan your investment, you can plan your retirement goals, and then you can link up your investment, adding inflation into it. You can plan your children education goal. Your so many things you can do, which is possible in mutual fund. In direct equity, you will have to do a lot of exercise yourself. There are no tools available. But in case of mutual fund, there are various tools which will help you to do complete planning for you. So that's why it's better. So it is being managed by AMFI, Association of Mutual Fund of India, which is apex body. They directly report to SEBI. It started in 1995 August, and then there are 44 now 45 companies are registered with SEBI. All renowned international and Indian names are there. Banks name, Kotak Mutual Fund, HDFC Mutual Fund, SBI Mutual Fund, even DSP Mutual Fund, which is internationally very renowned name. Franklin Templeton. So various mutual fund houses are there. So we are investing in mutual fund. There are two ways to make investment: lump sum or SIP. We'll talk about SIP first because this is the way through which a lot of people have created wealth with the small thing. How SIP work? It's a tool that allow you to invest in mutual fund through small periodic investment. Means after you plan your goals, you make your budget for yourself. You know how much is your income, how much money are your expenses, monthly expenses. You do estimation, annual expenses. You do estimation, and then you identify how much money I'm making, saving every month, at least this much of money. So then you start doing putting as an investment in SIP. You choose a date on which will be better date, and you start doing it. Gradually, it will start making wealth for you. वो कहते हैं ना, I will use the word in Hindi, बूंद बूंद से सागर बनता है. So with the small drops, you can create a big sea. So this apply for SIP completely, because I myself experience. I've been investing since 10-15 years, and I have done from so many of my clients. They started with small and they have very good wealth now. So this is it's like a magical tool in SIP which help work for them. So how normally people plan? Some money for their retirement, some for their kid marriage, for their education, for second child education. That's the way normally plan their investment. So when you do SIP, this is one calculation which I'm talking about, how it help you, how it negate the market movement over a period of time. So for example, market is going down or up. One person who has a lump sum of 4,000 rupees, at that time unit price was 10 rupees, he got for 400 unit. On the other side, another one is getting saving of 1,000 rupees every month. So at that time, he did invested 1,000 and he got 100 unit. Next month, the price of the unit, market went down, price of the unit went down to 8 rupees. So he got 125 units. Third month, it increased to 9 rupees. He got 111 units. 4 month, it went to 11 rupees. He got 90 units. So he got total 427 unit as compared to the person who is lump sum 400 units. So even the market goes down in early period or goes up, both way it work for you. If it goes up, your wealth grow. If it goes down, you get more unit. And over a period of time, because I told about India growth story, it has to grow in longer period. Then you create good amount of wealth. So this is called rupee cost averaging, which happen through SIP, which is really beneficial for everyone. If I talk about performance, this is the minimum return I'm talking about, because I've taken a average return of 99 schemes. Means minimum return you make at least. If somebody did 25,000 rupees of SIP, means he invested 45 lakh rupees, his wealth became 1.39 crore in 15 years. I'm talking about 15 years here. So with bias investing 25,000 for 15 years, you can create a wealth up to 1.34 crore. And it's easy to say, but I've seen that people have more saving, but they are not able to they are not able to create that much of wealth because they are not disciplined. SIP make more financial discipline, create more financial discipline for you. So that is the way it works for you. How much you need to save your requirement? For example, your retirement goal is 10 crore and you are thinking that 12 to 15% return you will make, then you need to invest 75,000 SIP, and that's the way you will create a goal of 10 crores. Now, one more question which comes to people's mind is, what should be the tenure of SIP? How much till how much time I don't have any risk of my investment? It should be dependent on your goal, on your financial goal. If you are looking for retirement goal, till that retirement you should have. If you are planning for your home, you want to buy a home after 5 years, it should be 5 years. If you want to buy you want to have your children higher education after 10 years, then it is a 10 years. So based on that. So then they say that, is there a risk in shorter period? Yes, there is a risk in shorter period, but the data clearly say that if you are invested for 5 years at least, there is no risk. There is 0% risk in equity through mutual fund SIPs, and there is a data which proves that. This data, they have taken a data period of 1994 to 2018, total 24 years. So it says that how rolling return, this is rolling return is one, I would say the minimum return, you can say that. 1 year, if somebody has invested for, only out of 6 year out of 24, when there was a loss. So probability of loss was 25%. Still average return was 25%. On the other side, if you increase the period from 1 to 3 years, I mean, you invested for 3 years at least, then the possibility has loan is 4 years out of 22 years. Means still there are 4 years when there's a possibility that you will end up in losses. But so probability of loss has gone down from 25 to 18%. But if you invested for 5 years, 7 years, 10 years, 20 years, or 15 years, there is a 0% chance that you will lose your money. You will grow your wealth, and the average return is very attractive. These are the maximum average return I'm talking about. These are very attractive. So I'm taking a lowest situation. Still, you will, if you are invested for 5 years, anything comes, you will create a good amount of wealth. Means you risk of losing the money is zero. So benefit of SIP, I'm just concluding on SIP. Impart financial discipline. This is one thing which is very important to bring more financial discipline in you. SIP bring financial discipline in you. Second thing is invest respective market condition. We spoke about that. Whatever the market situation, if you invest through SIP, you don't worry about it. Over a period of time, your money has to grow. You will create good amount of wealth. The third thing, cost averaging help neutralize the market volatility. Market keeps going up or down. It will average your cost. You'll get more unit if market goes down. If it goes up, you'll get lesser unit. Your money will grow. So over a period of time, it neutralize the market volatility. So you will definitely create wealth through that. And the last one, which is the most important in creating wealth, is power of compounding. We'll talk about that. That is very important. So start early and make more wealth. How it will happen? Because of power of compounding. If somebody, I'm giving example, there was Mr. Ali who did 10,000 rupees SIP. He was at the time 25-year-old and he invested for 35 years. So he invested total 42 lakh rupees. His 42 lakh rupees became 11.42 crore in 35 years. On the other side, Mr. Late started after 20 years. So he said, I have more saving, I have more money earning, so I can invest 20,000 rupees monthly. So but retirement age is 60. So he was left with 15 years. He did 36 lakh rupees investment. He created wealth of 1.23 crore. But where the difference is because of he gave more time, which money created money for him. Power of compounding, compounding interest, which is in 6-7%, but here you're earning a return of 12-15%. So your compounding will also multiply faster. So the difference is so huge. More early you start with investment, more wealth you will create. This person created wealth, but the way Mr. Early created wealth, there is no comparison. So the right way is start early, invest in right assets class, and save regularly, and you will achieve your goal. So I'm giving the example of power of compounding. Mr. Albert Einstein said that he was the biggest mathematician in the world, scientist. Thank you so much to the chairman. Okay, he did that. He said that power of compounding is the eighth wonder of the world. So how it is? Let me give example. If you are getting a 15% return, your 1 rupees will become 2 rupees in 5 years. If you 1 rupees will become 4 years, 4 rupees in 10 years. But your 1 rupees will become 8 rupees in 15 years. But in next 15 years, it will become 64. Means 56 times as compared to first 15 years. That's the way power of compounding work. Your money may start making money in a longer period for you, and that create a huge wealth for you. So if you have a saving, keep it for longer term and invest it. If you need it, you withdraw it. But if you don't need it, let it remain invested for longer period, and you will create good amount of wealth. And wealth is for generation. Income is for your family for this generation. But if you create a huge wealth, that is for generations to come. Mr. Buffett, Warren Buffett, he's the biggest man in the investing. He's the biggest example of power of compounding. You know, he started at the age of 14. He started with $5,000. $5,000. At the age of 60, he reached to 3.8 billion, which was a huge wealth. But if you see the growth afterward, because of power, and this growth came after because of power of compounding. This was also power of compounding, but here it start working because after 35 years, it was just multiplying. This 3.8 billion become 17 billion just in 5-6 years. 17 billion became 36 billion just in 6-7 years. And then 58 billion in 83 years. And now he's more than 190 billion assets. Every 5 years, his money is growing, multiplying like anything. And that's because of power of compounding. Now I'm giving example. We spoke about a lot of theory, how your money grow or how people leave the market at difficult time and how they are able to create wealth who stay in the market for longer time. I'm giving an example. A person, Mr. X, I'm taking example of Mr. Yuvraj, for example. He started investment in April 2000. So when he started, He did a SIP of 10,000 rupees. He did for 1 year. His total investment was 1,20,000. But what happened? 2001 dot-com bubble happened, and his money went down like anything. His return was minus 15.62%. The value of his 1,20,000 became 91,597. He was worried. What is happening with me? This is I invested. I'm not able to make money. Deepak told me that this is a place to invest, but I'm losing my money. He waited for another 1 year. His investment became 2,40,000. It grew a little bit in 2002, but his return was only 4%. Means his 2,40,000 became 2,51,000. He said, "Oh, I'm not enjoying it. I would have invested money in FD. I would have invested money in PPF or somewhere, or gold or silver. I would have made more return." He's very much worried. But Deepak said, "Wait, have patience." Then third year, he again waited 3,60,000 his investment, but it remained there. It did not move. He did not, because market was not moving. He's not able to create wealth. He got impatient. Panic started at that time. Then Deepak had a full portfolio review with him. I had a full portfolio review with Mr. Yuvraj, and I said that don't worry, stay in the market. This is a place to stay. Our future perspectives are good. Mr. Manmohan Singh is managing the finance very good. At the time, finance minister, I'm saying that's why. So he's managing India's economy very well. So stay there. Then what happened? Next year, his 4,80,000 became, because his 1,20,000 additional investment, his overall investment became 9,84,000, because during that year was a year of jump. So his overall annual return, which was at 4.34%, has become 36.66%. Overall annual return for 4 years. I'm not saying that this is annual return of 1 year. I'm saying overall CAGR for 4 years annually was 36.66%. He gone happy. He said, "Wow, this is a thing." It's just a start. He kept investing. His 1,20,000 invested. His 6 lakh become 15 lakh in 5 years. 36% annual return. His patience paid him. He created good amount of wealth. Then he's invested for another, like he kept on doing it. After 10 years, there were 12 lakh investment, and his value became 54 lakh. Annual return 27%, which is huge. And SIP delivered 27%. If I'm talking about 23 years, his total investment was in 23 years was 27 lakh 60,000 rupees, which became 2 crore 66 lakh in 23 years with annual return of 16%. And this is the data I have taken from actual numbers of SIP return of 19 equity funds. So this journey looks very difficult in start and middle, but later point of time, I'll say after 4 or 5 years, you will never come out of this, because you will see the growth in your money. And this money reached to 2.66 crore because of market growth. If you see, the return has gone down from 27 to 16% in 23 years, annual return, but wealth has created like anything. That's what I'm saying. Even you are making 12 to 15% return, you stay there, power of compounding will create huge wealth for you. And that will be enough for your family. That will be enough for generation to come. So this is one example. So, but if I'm saying to Mr. Yuvraj that you stay there for 23 years, will he stay? Until I don't create his goals. Financial goals are must. You need to make financial goals. If you won't make it, you won't be able to stay in the market for a longer period. Any investment without goal will not create enough wealth for you. You will leave in between. You won't be, because, for example, when I was working in Ford Motor Company, I was creating a goal for a financial plan for the company for 5 year, 10 year, 15 years. Why I was making it? Because they wanted to be clear where they want to be after 5 years, 10 years, 15 years, where they want to be. If we are doing it for our companies for which we are working, or to them we are providing services, why we don't create it for ourselves? That's what where people make mistake. So it is very important to have the plan, important to plan financials. You can start by preparing a simple budget sheet or net worth sheet. That's what I do with my clients. Simply sit with them, make a budget sheet, net worth. I'm giving example for that also. This is Mr. Ananya. You guys don't know him. That's why I'm showing the data of him, because he's from different field altogether. So I sit with him. I sat with him. I created that how much income he has, monthly income, how much annual income he's making because bonus or something is working. I understood where the grocery spending is happening, how the bill spending is happening, what is house rent he's paying, what are the transportation, and then we identified that his total expenses are because he invested in mutual fund. And annual expenses, if I take into account, his total expenses come out to be somewhere 48 to 50,000 rupees on monthly basis. Then I told them, you are making 78,000 on an annual basis, somewhere 1 lakh rupees, 1 lakh plus. So why don't you invest with 55,000? He agreed. We invested. He invested with SIP because we first understood what is the budget sheet saying. Then I made a net worth sheet. What are his assets? What are his liability? Where his money is invested? Then you need to see how much return you are making, whether you have created an emergency fund or not. Now you have to, what are your monthly expenses multiply by 6 months. For example, your monthly expenses are 50,000, multiply by 6 means 3 lakh rupees you have to put in saving, RD, or somewhere where you can withdraw anytime. That is the emergency fund for emergencies you have to keep. And then afterwards you have to invest. These kind of feedback I gave. I understood his investment. Okay, he has cash. So he said, I want to invest in equity. Some people want to put in real estate. So I calculated in the right what is the regular outflow, what are the annual return he's making from his different investment. If any investment is bad investment, I try to stop. I helped him to stop it and move to the good investment where the return is. How we identify what is the good investment or what is bad investment? Inflation. 6.5% is the benchmark, 6%. If your return is lesser than that from your money, means it's other than emergency fund, because emergency fund has to be kept. Other than emergency fund, if you have money lying anywhere where the return is lower than inflation, it means it's a bad investment. If it is making more than that, it means it's a good investment. So this kind of sheet I prepared. So we identified first he want to plan for retirement. He said that I'm a young guy at early age. We sat. He said I want to plan for retirement. I said okay. Your monthly expenses are 42,000. Is at that time his age was 32. I said at what age you want to retire? He said I want to maximum work till 55. I said okay, fine. And we could put a realistic approach, 13.5% conservative approach, not the realistic. Because like I told you, market is giving 15-16%, but there can be ups and downs. So I put a conservative approach while creating a goal. If we make more return, that's good, but we make a goal with conservative approach. And few assumption I took, like he will live till 85, inflation rate 6 to 6.5%. Then it system gave that 5 crore you need to invest, because at the time of 55 his monthly expenses, which are 48,000 now, will be 1,83,000 rupees at that time because of inflation. The cost will increase, so you have to prepare. To achieve this 5 crore, he had to start a SIP. Either he could do 30,000 SIP or a lump sum of 27 lakhs. So immediately he started with SIP at that time. Now look at his goal after a few years. He had one Everest goal, which is overachieved because I kept expectation of 12%. His actual return is 22%. He had, after 2 months, he has to go to Everest. For that, he saved. Then one dream house goal he created of 2 crore. There is only a small gap of 12,000 rupees, which when his income will increase, he will fill it. And then retirement goal. 5 crore rupees goals, 34,000 SIP, he's overachieving it. If he will keep doing it, he will easily achieve it. And that's the way people create wealth. These kind of financial goals keep you intact with your investment, and they are live goals. Means your current investment valuation show that how much money you need. Anytime you can go to system and see. If you will not create goals like this for you, then it is very difficult to stick to your investment. It is very important to create a financial goal for your personal finances also. We do it for our companies, we need to create for ourselves also. Any question till now? I think most of the thing I have covered, but yeah, few things are left. Any question till now? Please ask, because I'm speaking and I'm thinking that people are listening or not. I want to make it little more interactive.
Yes, sir.
So Yurajesh has to ask about some SIP, sir, because he is in need of some investments. Because he is yet to married, no?
Yeah, oh, he's a
Yuvraj,
bachelor.
he is a bachelor chairman. So Yuvrajesh. So I'm thinking when you are explaining about SIP, I am thinking about Yuvrajesh only.
Okay, very nice.
It's a
Okay,
good
Yuvraj.
opportunity, Marit.
Yeah, yes, it's a very good opportunity, you Rajesh, because you're a bachelor, you have limited liabilities. Not li I won't say liability, and you have little, you are like liabilities. At that time, if you will plan, you will be able to create good amount of wealth for sure. And I can see. So yes, true.
Sir, some of the member has messaged that please cover ETFs also.
ETF also. Okay. See, I have it's not in the PPT, but I will talk about it. So ETF are actually kind of index fund. They are the purposeful fund. The difference between these are the active fund I'm talking about. In active fund, you choose your advisor or you choose your fund manager. Straightforward. You can straight invest or you can choose through advisor. Definitely, there is some difference between the cost, which automatically count. You can't see into the funds. Um, but when you buy ETF, you choose your fund, and those ETF are very means they give you good return, but they are not actively managed. They are passively. For example, stock exchange, small cap or a large cap, it goes with the indices of that specific stock exchange. It is not managed by any fund manager. If I'm talking about Sensex, if Sensex will go up, it will go up. If Sensex will go down, it will go down. So it will move in line with the specific index fund or ETF you bought. So it has a lower cost without any doubt. There is no advisor or a distributor or anybody involved. Only the expense ratio is very limited and your return will be higher. But the here real thing is it is not actively managed. So when a fund manager actively manage your money, at that time you get a delta. Means when the market makes 15%, mutual funds can make 16, 18, 20, 25%. And that's happened. That's because of delta, because some experts are managing your money. But in ETF, they are very good. If somebody don't want to talk about this and still take a benefit of equity, that's the right place. Choose those specific ETF. Your cost will be lower. You will be investing it. But do that thing also by preparing goals. Always have very clear goal. I just took the example. You can prepare your own financials and create these kind of goals. If you will create it, you will stay intact with your investment for longer term, because it is easy to say that this guy made money in 23 years. Mr. Yuvraj made in 23 year 2.66 crore, but 23 is a longer period. So you need someone to talk to stay intact with the market, stay intact with your investment so you don't touch it. If you need an emergency, you withdraw it, no worry. But without any this thing, if you want to remain for longer period, you need to remain intact, and for that you need an advisor and you need to choose one. I'm not saying, I'm not advertising here on myself, because I myself chose an advisor when I was part of Ford at that time. So anybody near you, you should need to choose, because the cost is very smaller as compared to the return you are going to get in future, very lower, because the rate of cost is very less. But if you choose ETF also, always do the planning. That is also very good. Cost will be lower, return will be more, but it is not actively managed. It goes as per the index. How the index move, if you choose a small cap index or mid cap index or a flexi cap index, it will go exactly same like it. It doesn't have any. Okay. Okay. So I will move to the next topic. One or two topics are left. Balance fund with the SWP. So in mutual fund, there is something called systematic withdrawal plan. So there are people who have some good amount of wealth already created. Means somebody who has 1 crore, 2 crore. I mean, some good amount of wealth. So they want to have a regular income through it. So SWP is a very good example to create a monthly income out of your wealth. For example, if somebody is retired at the age of 60, He has some out of PP and everywhere he has 1 crore rupees, and he won some 1 lakh or some 50,000, 80,000 monthly. Then he can generate through S2P, and his principal money will also remain intact. The wealth will grow. How it happened? I'm giving example. I'm taking a 19 year. Normally, this money is invested in a balance fund because it's a huge investment. So, balance fund has a combination of equity and debt fund, both of it, and combination with the fund manager manages well. And for example, I'm taking a lump sum of 15 lakh rupees you invested. Investment period was 120 months. You want a monthly withdrawal of 10,000. You took it. Your total withdrawal in like 10 years, this 120 month would be 12 lakh rupees. And that 15 lakh rupees became 41 lakh rupees even after a monthly withdrawal of 10,000. This is actual data I have taken from 2000 to 2019. And your money went from 15 lakh to 53 lakh. How? 41 lakh rupees the maturity after 10 years, and 12 lakh rupees you withdraw in 10 years in form of 10,000 per month. So you made a 15.7%. That's the way you can do a monthly income also. Principal money will still be growing over a period of time. That's the way you can do that. How normally why people need SWP? Because they have to meet monthly expenses. They don't want to get their wealth hit by it. That's why they do it. Or they have to pay their children's school fees, their holidays, their insurance premium, their EMIs. For that, they do this kind of arrangement. So just to conclude only on equity mutual fund, we'll talk about two more topics, but yeah, this one is only on mutual fund. Don't panic with the short-term correction. If there is, like I showed you, if 1, 2, 3, first 3 years you have your money even go down, correction happen, it's an opportunity. It's an investment opportunity. If you have money, put more money. Don't get worried about it. Don't create a panic for it. Don't time the market. Like I showed the example, give time to the investment. If you time the market, you put money, you think that if somebody think that he knows when the market will go down and when the market will go up, then he will become God. Then he need not to do anything. He will have already huge wealth. So nobody knows it when the market will go down, when it will go up. It correct everyone. So stay there for longer period. Don't just when your money is already growing. People think that we will withdraw when the market will go down. We'll put it again. That doesn't happen because when the market is getting down, I know when during the COVID period there was so much fear in the market. So many people wanted to withdraw the money. At the time I had 60, 70 clients. So I just had a lot of meetings, made them understand. And I know that so how people lost the money because at the panic time, you don't think otherwise. You feel that I'm losing money, let's sell it, whatever left I take. That's the mistake people do. So don't time the market, invest for longer period and you will reap the benefit. And power of compounding we already spoke about. If you stay there for long term, you will make good amount of wealth through compounding. You all know that this is how the taxation works. Long term capital gain. If you're more than 12 months, you all are expert, but I'll just brief it. 10% after 1 lakh rupees of capital gain. Short term capital gain straight 15%. Whatever slab you have doesn't matter. If you are into non-equity fund, which are debt fund or all other than equity funds, then the taxation, this is changed, sorry, a little bit. 20% for long term and 30% for short term. Earlier, we used to get an indexation benefit in long term, but now there is no indexation benefit also available. Government has removed it. So in this, the slab is short term is almost your regular slab, our maximum slab, and long term is 20%. But equity has 10 or 15%, 10% also after 1 lakh rupees of capital gain in every financial year. If any NRI want to invest, there is a TDS in it, which is 15 and 10% for NRI investor. If people invest in ATC, anybody does the investment, ELSS funds are the best fund, I would say. Why? They get you double-digit return. Lock-in period is only 3 years. On the other side, if you put in PPF, return is 8%, 15-year lock-in period. NSS scheme, 8%, 5-year lock-in period. FD, 7%. Now it's not even 7%, 5-year lock-in period. LIC, 7%, not even 7%, I would say 5 to 6%, 10 to 20 years of lock-in period. So if you see this data, it clearly say that this is the clear winner. So if you have to save tax, if you have to invest under ATC, always do under ELSS fund. Anybody does investment in LIC? Anybody? In chat, I want to have answer. Anybody have LIC investment? Don't feel that I'm just be clear that yes, I have no. I also had investment, which I removed it now. But if you have investment, then you need to look at it again. Why? I'll show the number. LIC has three things. One is they have the life insurance. LIC has return also. After 12, 15, 20, 25, 20, 30 years, you will get the money. Even you have life insurance, you will get the money back with some returns. On the other side, you have health insurance. Some LIC policy has a health insurance of limited amount also. Now I'm taking an example of one. Sorry, this is I had one small Excel. I could not able to format it. Sorry for that. So I'm just giving example. One person who had 1 lakh rupees invested in LIC. So his scheme was saying that after 25 years, he will get he will have 25 lakh rupees invested. So he has to invest only for 25 years. After 30 years, means 5 years after 25, he will get 50 lakh rupees as money back. That's the way LIC product is sold, I think. And then if God forbid something happened to him anytime, his family will get 25 lakh rupees, which is a life insurance. On the other side, if he has they have a health insurance of 5 lakh. This is happen in very few policy, but it is there. 5 lakh rupees health coverage is also there. So this is the way arrangement is there in the LIC. Now I'm talking about a separate planning altogether. You rather than doing 1 lakh rupees, if you take a term insurance of 1.5 crore, you will get 11,000 rupees yearly premium you have to pay. So you pay that. So your coverage is almost 6 times as compared to LIC. So 1.5 crore term insurance means if something happened to you, money will 1.5 crore will be given to your family. If all goes fine, your 11,000 will go annual basis, which is non-refundable every year. Same way, you took a health insurance of 20 lakh rupees, which is 4 times compared to health. You paid a yearly premium of 10,000 rupees. So you did that out of 1 lakh rupees. Rather than taking LIC policy, you did these two things. You were left with 79,000 rupees. So what you did, you divided it by 12. You did a SIP of 6,583 rupees for 25 years. Only invested for 25 years. And then you waited for 5 more years. Your 5,083 will become 2.02 crore compared to 50 lakh, which is 1.52 crore more than it, with only annual return of 12%, which is very much possible. And your health coverage will be 20 lakh, your term life coverage will be 1.5 crore. So that's the way you can plan. Rather than going to LIC or traditional plans, always do a vanilla product. If the purpose is life, take a term insurance. If purpose is health, then take a health insurance. If the purpose is to create wealth, then put it in SIP or lump sum, and you create a huge amount of wealth through that. So this is one planning I'm just sharing, which is mutual fund versus property investment. So I want Yuvraj, what you believe, property give more investment or mutual funds? More returns, I mean.
I think real estate nowadays.
Real estate nowadays. Okay. The same notion everywhere is there. I completely agree because we have a physical asset which is visible. When we buy something, we have a physical asset. We believe that if the money is lying there in physical, we have something in hand because it's a huge investment it takes. Let's talk about some example. These slides are purely made by me. Other slides I took help from NJ. These are the my slides completely. So I took a data of you guys believe that the Mumbai is the place where highest growth of property has happened. Am I correct? So I have taken example of Mumbai. In Carter Road, Mumbai, purchase year was 1970. You sold in 2014. So you kept that property for 44 years. When you invested in 1970, the value of the property was 3.5 lakh and value became 85 crore in 85 crore in 44 years. If you convert into annual return, you made an annual return of 19.38%. On the other side, these are the properties which are the most grown property in India, one of the most grown property in India. Usha Kiran, I'm talking about, this is also one of the premium location in Mumbai. 1963, the value of the property was 1 lakh, which became 25 crore in 2011. In 44 years, it grew like anything from 1 lakh to 25 crore. If you convert into annual return, it became 17.70%. Then you have a Samudra Mahal in Mumbai again, 1970. The rate was 700 per square feet, which became 1.18 lakh per square feet with an annual return of 12.66%. So these are the few examples where the property grew like anything in longer period. I mean, if you kept it for 40, 45 years. Now I'm comparing with the Sensex. 1979 Sensex started. In 2014, I'm comparing apple to apple data, so same years. From 100 point, it became 28,000 points. So if you convert into annual return, the annual return was 17.46. Means as compared to property, returns are almost the same. Almost the same. I'm talking about Sensex here. Now I'm coming to mutual funds. This is the mutual fund which is now Nippon Mutual Fund. It used to be Reliance Mutual Fund. This is one of the oldest mutual fund of India. Reliance Growth Mutual Fund, which is now Nippon Growth Mutual Fund. In 1995, the rate NAV was 10 rupees, and in 2014, it became 705 rupees, from 10 rupees to 705 rupees. If I proportionately increase this 19 year to 44 years, your 3.5 lakh, which you invested here, which became 85 crore, if you would have invested same money in this Reliance Growth Fund, by 2014, it would have become 665 crore with the annual return of 25.1%. This is a practical example I'm sharing. The best mutual fund in India and the best property in India. The who is clearly winner is mutual fund. I'm not saying that properties and you don't have flexibility in property. For example, I spent 1 crore, I buy a property in 1 crore of 1 crore rupees for investment. For your own home, if you want to do investment, whatever you want. But I'm talking about investment purpose. 1 crore you invested, and after 1 year, you need only 15 lakh rupees out of it. You don't have it. So will you sell the property of 15 lakh rupees out of that 1 crore rupees? Is it possible? Not possible. But on the other side, if you are invested in equity in form of mutual fund, if your money is 1 crore you invested became 1.2 crore and you want to withdraw 15 lakh rupees, you can withdraw. Remaining money will remain invested. You will create wealth through this. Normally, how people buy real estate? The total house cost is, for example, 15 lakh. Down payment is 3 lakh rupees. Loan they take for 12 lakh rupees. EMI comes out to 12,895 for 15 years. And that's the way normally people buy a house. If for your own investment, you do for investment also, you do a one-time investment of 3 lakh rupees and a SIP of 12,895 rupees for 15 years, from the 3 lakh rupees, you will create 40 lakh rupees in a return. This is a 19% return. I'm taking a 15-year data from 2003, 4 to 2024. I'm so sorry, 2008 to 2024 period. 19% you made in lump sum 3 lakh rupees, and SIP gave you almost 15% return. You made your 12,000 became 79 lakh rupees. So in 15 years, your 15 lakh rupees became 1.2 crore. Are you sure that every property which you buy will be able to give this much of return to you? Your 15 lakh will become 1.2 crore in 15 years. In shorter period, in the piecemeal manner, sometimes it grow very fast, property. But if you take a same longer period, 10, 15 years down the line, equity is the winner. And there is a reason for that. Why? These are the world richest people: Mr. Jeff Bezos, Bill Gates, Warren Buffett, Bernard, Mark Zuckerberg. These are the people who are into business. So Warren Buffett, Bill Gates, Ambani, Tata, Premji, and Murthy, Mittal, Birla, are you listening? What our good friends are saying? You guys don't know how to make money. Listen to our friends. Sell your all the companies. Invest in properties. You will double your money, and that too without putting much effort. No expertise required. Will they do it? They won't do it. They will keep money in the businesses. They will keep investing it because how the whole circle work. I'm taking the example of Gurgaon. 25 years back, Gurgaon was a jungle. It was a jungle. They were very small town. It was one of the smallest town in Haryana. Nobody used to come here. But then the business came because Delhi was completely packed. So it was nearest Delhi. So all the businesses, all the companies came here. Then the employment generated. Employment generated, population came. They brought their family. All over India, all over world, people come to Gurgaon. The population increased. Then the demand of real estate increased. The price of the property, which was a very small, became huge. But at that time, Maruti was there. If I would have buy Maruti share at that time as compared to today, the real estate price which has gone from that to that, Maruti price or the shares would have made far more wealth for me. That's what I'm saying. Always businesses give more wealth compared to real estate. Real estate is the result of any business which is giving wealth. If any place grow, then the property pricing. So why don't you we invest in businesses as compared to real estate? That's it. Thank you guys. This is my presentation. Please ask question.
Deepak, I want to ask you something.
Yes.
If I put my money in real estate, I will make an investment simply and forget it, even for
Yes.
20 or 25 years. So,
Yes.
is it possible if I make an investment in mutual funds or somewhere, whether it
Yes.
is possible to take the to manage more up to that longer period without taking the money, because the money is available to me readily. So whenever
Yes.
a need comes, I will try to encash that mutual funds.
Yes. That's what I was agree
Yes, I will.
completely.
I will bear the patience. I will have a patience when I purchase a land.
I completely agree. This is the mindset we need to change. And how we will change?
That,
We
that is
need.
what I am. That is what I am asking. One more question.
Uh-huh.
So I am a small investor in mutual funds till recently. I
Mm-hmm.
entered in share market for the last 6 months.
Okay.
So how, because my observation goes is, so investment planning in equity shares is only 10% and
Mm-hmm.
managing emotions is 90%. So
Yes.
how to manage the emotions? Because I am trying to manage the emotions first before making a huge investments in equity funds.
Yes. See, even you invest in property or you invest in equity, because in the problem is in property when the movement happen, there is no standard data which you can see that today rent rate went down or today rate went up. There is no data, but property valuation goes down also. That happen. So we are not able to see, and we have a physical assets in front of us.
In the history also, there is no way of property is coming down. For example, I tell you, I have invested 2 lakhs rupees in the year 1997. Now the cost is market value is nearly 2 crores, 100 times. And
Yes,
one
I
more
agree.
classic example, I will tell you, I invested 11 lakh rupees in 2001. So now it
Yes.
is 5 crore rupees.
Yes, I agree. I
So
completely agree.
if I put in the same money in mutual funds or equity, is it virtually possible to take that money back? Because it is emotionally attached. Suppose if I selected two shares, if I put money out of that, if I put money in one stock, the stock which I purchased, it not started moving up. The other stock which I omitted, no, that stock will start moving. That immediately my emotions will get changed. And
Yes, that
after waiting some time, then I will dispose of this. Then I purchased that one. So immediately after purchases, that prices will consolidate. That
Yes.
the stock which I have sold will start moving up.
Yes, completely agree. So
Yeah,
that's
is
why
no, it
yeah.
is very difficult to manage emotions. Do you have any
Yes.
idea? Because a lot of investors are there. Do you have any idea to control the
The
emotions?
Yes, to control the emotion, you always need an advisor. I can tell you, you always need advisor. If you will think that, as a child, my experience was that till 2014, 13, 14, I was managing my money myself at that time when I was into job. I was, and one day I prepared the same way. I met with one advisor and he told me, I'm giving my example. So he told me that you need to do this basic investment and this planning, budget and net worth sheet you need to prepare, and then you need to plan your investment. Fine.
Yes.
And I said, I'm a chartered accountant. Why I need to do that? I know my money, but I had my own self ego. So I waited for 6 months, but one day I said, okay, let me sit down and see in equity. I'm putting the money here, there, mutual fund, equity shares, somewhere here and there. It is spread. Let me see how much money I've made. I I was surprised to say that I didn't make even 5% annual return. I didn't make. Why? Because I was putting that money somewhere and continuously watching it. First thing which we do is we buy a share, we continuously watch it, and because it's our money, our own money, so our emotion get attached automatically to it. So first we need to invest somewhere where we are not clear how it is moving. So
Yes,
that's why
exactly.
mutual fund. That's why mutual fund came.
So
I'll give
mutual,
you.
yeah, sir.
So
Mutual fund
that
also, I got one example, sir. Mutual fund also, I got one beautiful
I
example.
agree. I agree. Sir, just let me complete for 5 minutes, then I'll take it up further. So, first thing is rather than buying straight equity, if you are not expert in equity, if you are doing in bits and pieces in equities, you should avoid equity. You should put everything in mutual funds only. Not everything means your investment according to your plans. And then you need to have an advisor. He will take decision for you, finding mutual fund, investing there, doing the shifting, assets allocation, changing some money, everything he will do. And every 6 months, you have a portfolio review with him. He will explain you how the things are moving and how it will move further. Then the possibility of chances of loss will go down by 90%. I'm telling you. And that's what happened with me also. In 2013, 14, when I chose my advisor, afterwards, 4, 5 years, I came to know that I'm making 16, 17, 18, or 20% annual return compared to which I was making 4, 5%. Because I was not looking, first thing, I will randomly look at mutual fund. And in one mutual fund will invest in various companies. And looking in detail is very much impossible. And on the other side, I'm not deciding on mutual fund. My advisor is deciding, and his 9 to 5 duty, 9 to 7 duty is to do this work only. And he is taking help from company like I'm associated with NJ here. Those research data they give, and he take all their client decision based on the facts, factual decision he take. So he, and when you have worry as a client, he will talk to you. He will have meeting with you. He will sit down with you. He will show you the portfolio, give the reason why the market went down, and why how it will grow back. He will keep you intact with the market, with staying invested in the market or in equity, and then you will start creating wealth over a period of time. That, believe me, if you will just stop, because in property also we left it and we don't look at it same way. Here we need to choose one expert who will manage this investment, your investment, and let him do all the work. Or when you have worry or question, you tell him, let's have a meeting, I want to know why things are not happening. Then he will have enough logic or reasons to explain how the things are moving and how it will move towards you over a period of time. Then you will get clarity, you will have comfort, you will wait. And if you will wait for, like I showed you the data, if you'll wait for 3 to 5 years, you will not go out, you will stay there. First few years can be very ups and downs type. So to manage those emotions, you need to have your advisor. I'm telling you about the in India and US comparison. In US, 85 to 90% people have advisors. In India, not even 5% people have advisors. See the difference. And that's the way global economy, developed economy does. They don't manage their finances. They choose advisor because the cost is very low compared to return you are going to get. And they are everything is managed by SEBI, the percentage, everything. So just at lower cost, you can have a one person who will manage your investment. Your emotions will not be attached, and then you will grow well. This is the way.
One more sessions to all the participants.
Yes.
So youngsters, my sincere advice them is don't directly move into equities. Before studying the equities, analyzing the equities, let them go to mutual funds first. So
Yes,
because
they need
no,
to.
why I am suggesting is so last 6 months I put my money nearly about 20 lakhs over a period of on a different period, not at a time investment, but I earned nearly 2 lakh rupees. But still, because I am aged, I am not greedy, but I am studying the way how the equities are moving and controlling, managing my emotions. See, because I am trying most of my time to control the emotions first.
Yes,
Because the youngsters, they may be very greedy of earning more money at the beginning.
yes,
So
yes,
in
yes,
the process of greedy, without controlling the emotions, they may lose the money in
yes,
share market.
yes, yes. Completely agree, sir. I
But still,
very much agree. And I've
yeah,
seen
though
people.
I earn money, I am not comfortable in putting the more money into the equity.
See, the if you follow the right process, equity
Yes,
will create good wealth for you. But follow the through the mutual fund and
yes.
choose if you are able to manage your emotions, then okay. If not, then choose the advisor. They
Mutual
will
funds.
manage your emotion.
Mutual funds. I want to tell one practical case of me, sir.
Okay,
So,
sir.
2019, I approached one private bank for a locker.
Okay.
At the time of giving locker to me, he asked me, sir, to take a policy of 1 lakh, 1.5 lakhs every year. Up to
Mm-hmm.
5 years after that, if you don't want, you can take your money back. And so I thought that it was only a life insurance policy. But after fifth year, then I suddenly, because I have totally forgotten. So what
Okay.
policy? After 5 years, I just gone through the market value, but luckily it was not totally insurance policy. It is units linked with death policy. So I verified the market value in the month of March 24. The market value of the units was 12 lakh rupees. So my 1.5 lakh rupees each year from 2009 to 23 has become 12 lakhs.
Mm-hmm.
And recently, yesterday, I verified the market value of those things. It has become 13.37 lakhs.
See, that's the way.
Mutual funds also, my advice to the youngsters is don't go for a short period.
Yeah, don't go for a short period.
You have to go for at least 10 years,
Yes,
15 years. If you
yes,
keep the money in mutual funds a longer period, then only the benefit will come to you.
yes. Like I shared in my presentation also, more the period you give, more wealth creation you have through various things. One is through power of compounding, consistency of return, and discipline of investment. It comes to you through SIP, and that's the way you create wealth. So if you give period to your investment, then only you will create a good amount of wealth. Agree, sir. Completely agree. Okay, I see few questions from people, which is there. One is term insurance. Shrikant has written. Anything you want to ask about it, Shrikant? You mentioned term insurance, so just I don't know. Okay. Next question. Please check calculation after considering tax impact. Sir, annual return with CAGR I'm talking about, that's always before tax because we have to do comparison with all kind of assets. All those such returns are also before tax. Tax calculation, I already covered one slide where how the taxation is. In equity, in long-term capital gain is taxable at 10% after 1 lakh rupees for capital gain every year. So up to 1 lakh rupees of capital gain, you don't have any tax. If you sell, then only you have a tax. And after that, 10%, which is the lowest in all kind of assets, wherever you invest. If you invest in FD, 30% means if you have 30% slab, 30%. So when I do the comparison, then it's before tax always. So for tax purpose, everybody has his individual state. Somebody has different tax, somebody has different. So we cannot have apple to apple comparison after tax. So that's why all the return was shown before tax. And next one was, good evening, sir. Due to American fiat currency, gold did not get the expected growth, but since the global economy going for realization, including USA, gold is the new currency, and all central bank are going for gold purchase drastically. Gold now is not a good investment to sir. Isn't a good, sir? Yeah, that's true. But because you have to diversify, diversification say that some money in property, some money in gold, some money in equity, some money in FD also. I said that for shorter period, always if you need money up to 3 years, for example, you need money after 1 year, 1.5 years, always keep in RD, FD or somewhere there. Never put money in equity or property or somewhere because you don't know in smaller time how they will react. If you need to invest for longer term, then only go for equity, which is 3 4 year at least. Then only you need to go that. Any wealth advisor recommended for us? That I am my
Our investment period is 10 to 15 years.
yes.
So investment in index funds or mutual funds, whichever is better, which is better, and what are the pros and cons?
Okay, index funds are, if for example you are happy, it's all depend on your expectation. Like I told you, index fund does not have any mutual fund manager who is actively managing it. Means based on the market situation, if they have to move money from for smaller cap to large cap or large cap to mid cap or different categories, then if you the delta if you want to create, you need the active management, which is done by mutual funds. But if you are happy because currently Sensex or this all indexes are giving good returns, so if you're happy with that return, put an index and forget it.
Now,
The real
Yuvraj,
thing,
tell me, sir.
the real thing is people think always about returns and they put money somewhere and it doesn't come, they move to another one without advice. And then when the wealth creation doesn't happen, no, they move money out. Like Mr. Reddy gave example. The money, if it is not coming in shorter period, is going down. They are not able to manage their emotions. That's why they are not able to create wealth. That's why they need somebody who can manage their emotions. So that's the way it helped them. So both places are good. If you can manage it well yourself, then you can choose funds also. But if you feel that it's very confusing, then take a ETF and put money there, or index fund, put money there. If you are happy with the return of index fund, 10 15 years are also fine because it is also associated with India growth story. If our economy will grow, see, I'm giving very straightforward example. You are expecting a growth GDP growth at 7% next 5 years, for example, 5 10 15 years currently, and your inflation is 6.5%, and the return expectation should be GDP growth, which is 7%, plus 6.5% of your inflation. 7 plus 6, 13.5% should be expectation. If you put high, because currently in last few months, the returns are very high. So people have high expectation, 20, 25%, 30%. That is the problem. That is the problem. They feel that this will stay, but you have to see a data of 30 year, 40 year down the line, and then see how much return is coming and put expectation based on that. Earlier inflation in Mr. Reddy's 20s age, 30s age, inflation was 9%, 8%. Then the return of expectation of 15, 16% was practical. But currently inflation is 6.5%. Then now if you will expect 16, 17, 18% return for longer period, then you are not doing a wise thing. That's where I'm saying, if you will invest in active mutual fund through advisor, then they will bring delta for you. For example, market is giving 15, 16%, they can get you 18, 19, 20% also. But if you will put in ETF or index fund, there is no delta there. where how the market will move, overall index will move, you will make money. So that's the difference between the mutual funds and this. So the real key is invested for longer term, stay invested, keep doing, whether market is low, up, whatever happen, you stay invested and keep doing portfolio review with advisor so that he manage your emotion also. Okay.
Yugraj, my advice is even for mutual funds also. So instead of going for indexed funds is presently, as Deepak said, that it is index is increasing now. It is comfortable, but being a professionals, we have to forecast the future of the economy also. So in the coming 5 years, which industry is going to be performing well? Defense, railways,
Yes.
power. So if you take the mutual funds in that category, and you have to, as he said, you cannot keep putting your money for the entire 15 years. So once in 5 years you have to appraise. So what about that industry, whether that phase is over, then we have to convert into that new area also. So then you can make more money still than instead of keeping for 15 years. And my suggestion, because I have studied the last 6 months, the entire scenario of the market and mutual funds, having totally involved. And Deepak, one more practical issue for investors is, when I put my money in real estate or mutual funds, I will forget it. But
Yes.
when I invest in share market, the next
You
day
can't
I
forget
start
it.
seeing that. So 1 rupee increased, 2 rupees decreased. That is why I'm selling up to stage of controlling your emotions. It is better to make investments in mutual funds, that too the anticipated growth oriented mutual funds. There are mutual funds, IT sector, finance sector, power sectors. So you can anticipate and you invest that. Once in 5 years you can appraise that, and you can change that
Sir,
sectoral wise, you can change.
you have very good clarity on it.
Yes,
Stick to
sir.
it and keep guiding all of us.
No,
Actually,
actually, I am planning to take a physical class also in near future, but I am going to take, because the controlling emotion is very, very, very important.
very, very, very
Because I am
important.
trying how to control the emotions. After myself comfortable in controlling the emotions, then I will try to take class also.
Actually, you need to diversify your investment. I'm not saying that don't put in property. You put in property, you put in
No,
gold, you
property
put in
stage,
your silver.
I am 60 years, sir. My investment property stage has been over.
Yes.
So I don't need any investment in property now. That's why
You
at the
need to
age of 60,
convert.
I have come to the this thing. So
Then
being a
you,
financial person and being interested in share market, because I am having lot of interest in share market, because I am unable to control emotions all these years, and I cannot leave the profession, because profession is more important for me.
yes,
So
yes,
I am
yes.
totally out of the purview of the stock market. But now till the last 6 months, I have entered into the market, because now I am not greedy and I am controlling the emotion. First, I am trying to controlling my emotions.
Sir, it is important. Let me give example. I have already met almost 500, 600 people in last and managing their financing and all things. I can tell you it is almost impossible. And myself, when I was into job, it is almost impossible to manage your own money emotions. My money, I'm managing 200 plus people's money, but my own money is managed by my advisor still. I can do it myself, but I don't want to because
Definitely,
somebody has a
if it
factual
is
thing, he
others'
manages.
money, we can able to control our emotions. If it is our money, then it will be
It is
difficult.
really important because when they will take the decision, they will take on the
Even, but
factual
still,
basis. They will
sir,
not be emotionally attached
even advisors are there. First, we have to try to control emotions to the extent possible from our side.
from
Then
outside. Yeah,
we have
completely.
a more control over the market. And
Completely agree, sir.
we have to observe the whole scenario, how to play the game, because it is almost like a game. We have to know how to, even in equity shares. So what I observed is keeping the putting the money in equity and seeing the highs and lows. There's no point. So
There's no point.
we have to make profits in between also by
Yes.
fixing some targets. Suppose if I have invested some money And my observation for the last 6 months also, by putting 100 shares in this share and 100 shares, 200 shares, and having multiple number of shares, it will not give much yield to the people, investors. And if you want to really make money, you have to have a huge quantity of that shares. If you have confidence on that shares, you have to accumulate the shares. Then you have to play with the shares. Suppose if I have 1,000 shares on my hand of a particular share, then I can dispose. When the share price increases by 10% or 20%, I can dispose 20% of my portfolio. Then I can make money. And even if the rate increases, I'm happy. The remaining 800 shares are there. But if the prices comes after again 20% down, I can able to purchase that 200 shares again and make some profit in between. I am trying to do that also now.
Sir,
Because I am learning, I have learned a lot, but I am still a beginner. I feel that I'm still.
There is no limit of learning in it. You will let me give example of Mr. Warren Buffett. Whole of his age, he made a lot of money by putting money in equity, and he's one of the biggest, not one of biggest investor of the world, biggest investor, and who create wealth for himself. But his whole theory is getting wrong in his last 4 or 5 years of age. Last 4 or 5 years, most of the investment he has shifted from equity to debt funds or debt area, thinking that US stock market will go down, then I will put that money there. But last 4 years, even there is a huge bubble in US, it's not going down. So his whole theory from age of 14 till the age of 85 is getting wrong at the age of 90. So there is no limit. If he can be wrong, anybody can be wrong. So that's what example I want to give. So equity is the place where you can. Yes, sir.
Deepak Garu, this is Madhusudan from Tirupati.
Hello, Mr. Madhusudan.
I'm dealing with shares for the last more than 10 years. The equity, I will be directly dealing 100% in equity directly. But I have not incurred any loss because of some time we have to spend every day and acquire some good companies are seeing the fundamentals and reviewing, and some time we have to spend every day. Then we will not lose, but even the price may come down, we have to stay in the market. Again, it will come. It depends upon type of company where you have invested.
Yes, sir. Agree, sir. Agree, sir. Completely agree. Like I told you also, if you are an expert in equity, then equity is very good market. But if you invest in equity in bits and pieces, you are doing 10 other job and you are into equity also, then it's very dangerous for you. Then it's
correct. We have to seek the advice of some advisors. Otherwise, we will run into losses.
Madhu sir, if I have a small portfolio, Madhu sir, if I have a small portfolio, then I can easily manage. If I want to invest more money, say 1 crore or 2 crores, then emotions will come into play.
For that emotions, emotions, why it will come into picture is that we will be attached to the share, or maybe we want to immediately we want to sell off and get the amount. So if we have to keep the emotions separate, acquire the shares, good shares or good company shares, but we have to review from time to time. On a long-term basis, we will be get benefited. That is my view.
Madhu sir, one thing here, see, I have purchased some shares. There is a volatility in between days. I have to make a control when I have to sell, when I have to buy, because market is moving every day.
Yes,
but
sir.
one thing, Ravindra, you are correct. You are correct.
Sir, sorry to
interrupt.
interrupt.
The company is one part. Understanding the company is one part, because we are financial people. We know in the long run it will give a benefit, but in between we have to manage how to emotions.
Yes.
That is very important.
There, what is required is staying in the market.
Madhu sir and Ravi sir, Deepak sir, now we will control our emotions since the session already 15 minutes.
See, I am not See, the
You
theory
are
or
on
what?
fire, I can understand, but it is a lengthy subject that we have to
Yes,
discuss for
yes,
much
yes.
time. Now,
Okay.
Yuvraj,
Yuvraj,
So I have put my visiting card on the message to everyone. If
yes, sir.
anybody need any guidance personal finance, they can contact me. And I think, or if anybody has any question, they can ask me. I'm ready to answer. But my presentation is completed.
Any other questions from the members?
questions will start only when they start investing
Lose
and lose some money not
some
gaining some money
Sir,
because in
until
this market everybody is hero.
Sir, until it is not sold, it is not lose. Until
Yes.
you stay there, it is unrealized loss again, it is not a loss. So stay there for longer period, everybody will create wealth because
Yeah.
our growth story is very good.
Deepak Gar, you will be giving advice on equity or the mutual funds also, or only on
Only mutual funds, sir. I have learned it very hard way that
Okay.
equity is not, straight equity is not for me. I'm
Yeah,
not for my
correct,
clients
correct.
also. So that's why only mutual funds.
You are correct. Mutual funds also we should be selective. Otherwise, we'll run into losses.
Yes, very much because every mutual fund has its own goal. You
Yes,
have to associate your purpose or goal with your investment. When you do that, then it happens. You achieve it, sir.
you are correct.
So thank you for your wonderful insights, sir.
Thank you, thank you, thank you.
I request Tirupati branch secretary Simadri sir to present a vote of thanks.
Thank you. First of all, at the outset, I, on behalf of Tirupati branch, Nellore branch, and Ongole branch of SISF ICI, extend my thanks to Deepak Narang sir for giving a very good insight into the subject, which is very required in the present scenario, wherein we are having certain limited or small amounts to be invested certain in certain areas. That is the right area to be invested in, and where people are having much more amounts only can invest in the property and all. Even more, a small person having a small amount can invest there in the equity market or mutual funds, which will be long run or short run, whatever be the scenario that they decide. Thank you for having a very good subject on this particular area, and we are very thankful to all the managing committee members of Tirupati branch, Nellore branch, and Ongole branch, and all the participants who have participated in the virtual mode, which is a very good webinar. And definitely in future also, we are in need of the physical seminar that will plan accordingly in collaboration with Nellore branch with a good initiation by Yuvrajesh as well, and our chairman Ravindra Reddy sir's initiation. Thank you one and all for having your patience and participation in the webinar. Thank you, Deepak Narang sir, once again.
Thank you very much. Thanks for the opportunity.
Thank you, Yuvraj.
Thank you, Reddy sir. Thank you,
Thank you, Deepak Gar.
Thank you. Bye.